Hello everyone and welcome to a short presentation on PNC Infratech. So this is the latest stock recommendation by Ventura Securities. Firstly, a brief about the company. Incorporated in 1999, PNC is a north-based EPC BOT contractor. 75 to 80% of its order book is concentrated in the north, and it's engaged primarily in the construction of highways, runways, power transmission lines, industrial area development, and other infrastructure activities. In terms of its order book, PNC's current order book is at 5,100 crores, that is 2.5x FY16 EPC revenues, and further PNC has won around 1,400 crores worth of orders from April 2016 till date. So this has not been included in the order book, and financial closures of these are expected to be achieved by October 2016. If you look at the snapshot of the company, basically PNC earns 84% of its revenues through the EPC contracts and 16% from BOT projects. Now, in terms of EPC, it has executed 34 road EPC projects, nearly 19 airport runway projects, along with an electrical railway line of the dedicated Eastern Freight Corridor. And its BOT portfolio is also robust. It has about 7 operational BOT projects, out of which 1 is an OMT project, 4 are toll road projects, and 2 are annuity projects. If you look at the toll projects, there's a list given down in the chart of the toll projects and the annuity projects. So in the annuity project, the Narela industrial area is not a road annuity. It's the construction of an industrial area. Moving on to why we are optimistic on the prospects of PNC. Now, just to give a perspective, PNC in a short span of time, that is in 15 years, has successfully executed about 34 road EPC projects, like I mentioned earlier, along with 19 airport runway projects, and it's developing operating 6 BOT projects. And in terms of EPC market share, PNC enjoyed 11% market share of NHAI's 48,100 crore EPC order book in FY16, which is second only to the infrastructure behemoth L&T, which had a 12% market share. So this is the pie chart which shows the market share of various players, and PNC is only very marginally behind L&T in terms of NHAI's order book. So it has established its position in this segment quite dominantly. Secondly, there are multiple green shoots in the road sector. So the road sector actually witnessed a period of lull during FY12 to 14 as players' interest in BOT projects dwindled. Project awards by MORTH plummeted from 9,900 kilometers in FY12 to 3,621 kilometers in FY14. In fact, the award rate of projects also fell from 17.7 kilometers per day to 3.9 kilometers per day only. Now, this sharp fall in the order pipeline was an account of high upfront capital requirements. Now, when I say high upfront capital requirements, I mean that majority of the projects were awarded on a BOT basis, where the entire responsibility of funding the project cost is with the developer. And during this period of macroeconomic slowdown, that is FY12 to FY14, traffic estimates came far below expectations, causing financial stress to BOT players, making them unfeasible for making it very difficult for them to meet the funding requirements. Second is stringent bank funding. Now, as the low collections, banks turned stringent in funding these projects, and further procedural delays only added to the woes and caused inordinate delays in the commissioning of road projects leading to suppressed returns. This is why if you look at in this chart from FY06 to FY9, we can see that there has been a 48% CAGR degrowth in the length in the road length awarded by NHAI. However, since then, since FY13 actually, the sector has seen a revival. In fact, there's been a 53% surge in the roads awarded from FY13 to FY16 on the back of several initiatives by the government. Now, what have been those initiatives? Let us look at each of them. First is the impetus to EPC projects. If you look at this chart clearly shows how EPC, which was earlier a favorable mode of construction, was replaced by BOT projects, and eventually from FY13 onwards, it was the EPC push which led to a revival in the sector. So in EPC, basically the funding requirement is not borne by the developer; it is borne by the concessionaire, giving the players flexibility to execute these projects. Second step taken was emphasis on faster execution. Now, if you look at this chart, we can see that in the recent months, the pace of execution has really picked up. In fact, the average execution of 6.3 kilometers per day in the first 2 months of FY17 translates to a growth of 20% Y on Y. So this is a very good pickup in the pace of execution. This has been possible by a number of initiatives that have been taken, one of them being an ordinance to amend the new Land Acquisition Act. Now, what does this act say is that the responsibility of land acquisition and other clearances is entrusted to the NHAI alone. Secondly, NHAI will not award any road project unless it has acquired 80% of the land for BOT projects and 90% of the land for EPC projects. The Act has also delegated power to local registries to grant forest clearances, which in fact can now be obtained online also. Further, the government is also mulling over granting additional powers to NHAI so as to do away with cabinet approvals at each and every stage of the project. So we think that these measures will go a long way in translating into robust growth for the road sector in the coming years. After faster execution, there has been a launch of the hybrid annuity model, which has seen significant pickup in the recent months. So, hybrid annuity model is essentially a mix of EPC and BOT projects. We have detailed the model out in our report, but in very brief, the government will contribute 40% of the project cost under the HAM model in the first 5 years through annual payments, and the developer will be responsible for raising the remaining 60% through the debt or equity. Semi-annual annuity payments will be made to the developer for the balance 60% of the project cost, and the revenue collection will primarily be responsibility of the NHAI. So NHAI will collect the toll and pay the developer annuity payments over 15 years along with interest thereon at bank rate plus 3%. The main advantage to the developer is that it lowers its financing burden with no traffic risk, and for the government, the basic advantage being that it's attractive enough to encourage PPP contracts even by footing only 40% requirement. So in FY16 alone, 9 projects were awarded worth 83 billion, and in fact, NHAI has also stated that 40% of the upcoming projects are to be awarded under the HAM model. So this model has actually encouraged a lot of private sector participation into the sector. After yet another reason for the pickup of activity in the sector has been amendments to the model concession agreement. Now, we have again detailed this in our report, but the two major amendments are that there will be deemed termination of projects if the appointed date is not within 1 year of the agreement date, and secondly, back payment of premiums payable by the developer to NHAI is gives them a lot of gives the developers and the lenders the ability to match their cash flows. So these two amendments in particular are extremely favorable for the sector and have encouraged more activity. So if we have to sum up the story in a nutshell, these above measures, coupled with higher budgetary allocations for the roads, gives us confidence that MORTH's ambitious target of constructing 15,000 kilometers of roads in FY17 could well be within reach. So increased pace of project awards coupled with faster execution and higher allocation for roads in FY16 may help meet more ambitious targets. So our outlook on the sector is extremely positive at this point in time. Coming back to how PNC will benefit from the sector uptick, PNC's dominated states account for 36% of the total road length to be awarded in FY17. So, like I mentioned before, PNC's primarily has executed orders in the north, and the major states being UP, Jharkhand, Bihar, and Rajasthan. And if you look at the upcoming projects that NHAI has lined up, we will find that 36% of these total projects are actually in PNC's dominated states. So naturally, PNC will become a direct beneficiary. And the reason why PNC chooses to operate near its core area of operations is because this really helps it to save costs due to logistical synergies and faster execution through in-depth understanding of local conditions. Coming back to segment-wise revenue forecast that we've made, PNC, like I told you, has an order book of 5,100 crores, that is 2.5x FY16 EPC revenues. Further, it has won around 1,400 crores worth of orders from April 2016 till date. So, given the steady and robust order visibility, we think that the order book is set to touch about 100 billion by FY19, and EPC revenues will grow at a CAGR of 17% to 3,227 crores by FY19. Moving on to the BOT portfolio, one important point to be noted in this segment is that PNC has met the entire equity requirement of rupees 4.6 billion for these projects. Hence, there is no further requirement for equity infusion. We expect total toll revenues to increase at a 3-year CAGR of 25% and reach 750 crores by FY19. So the CAGR is robust because most of these road projects have recently commissioned and traffic is expected to pick up from here on. So this table captures the snapshot of the entire BOT portfolio that PNC has, and you may get back to us in case of any queries in this regard. If you look at the margin profile of PNC, it has been able to expand its EBITDA margins by nearly 500 bips in the past 3 years. That is from 12.8% in FY13 to 17% in FY16. This has been possible because PNC has been very conservative in its bids, which provides a natural cushion for margins. If you look at the table that we've put up, PNC actually has the highest premium above the benchmark cost, that its average bidding has been about 7.2% higher than benchmark cost, followed by GR Infra and Dilip Bilcon at 4.6%. The other reasons why it is able to maintain, or the other reasons why it has been able to expand its margins, is because it follows a no subcontracting policy for critical construction activities. And the third major point is that it has its own equipment bank. In fact, we have detailed the equipment bank it has in our report. And with such a robust bank, it does not rely on outside rentals for equipments, saving on lease cost. So this has been the reason why it has been able to expand its margins. And going forward, we expect EBITDA margins to further expand to around 20% by FY19, as the contribution of high margin BOT projects is expected to increase from 16% in FY16 to around 20% by FY19. So BOT projects have EBITDA margins in the range of 80 to 85% as compared to 13 to 13.5% in the EPC space. So even though EPC will continue to um, contribute majority of the revenues, the fact that the BOT projects have such a high margin that even a small increase in contribution can lead to an overall margin expansion for the company. Moving on to the financial outlook, we expect revenues of PNC Infratech to grow at a 18.8% CAGR, led by around 17% CAGR in the EPC segment and about 25% revenue growth in the BOT segment. EBITDA margins are expected to inch higher, like I told you, because of the increasing contribution of BOT projects. PAT will grow at is expected to grow at a CAGR of 19.7%, and debt is expected to reduce and interest coverage will continue to remain high. Along with this, return ratios will improve to nearly 20 percentage plus levels. Now we have initiated coverage on PNC Infra as a buy with a price objective of 187 rupees, representing a potential upside of 52% over a period of 18 months. So the current market price is hovering around 122 rupees and we're giving a target of 187 rupees. So we've used the SOTP method to value PNC. The EPC business is valued at 159 rupees per share, based on a 15 P multiple on the FY19 estimated EPS of 10.6 rupees. And the valuation of the BOT businesses is coming to about 28 rupees per share, which implies a 1.6x price to book. So on a consolidated basis, our target price implies a PE of 16x and 12x on FY18 and 19 EPS estimates. Yes, thank you. That's all that we had for PNC Infratech. So I'll just repeat that we've initiated coverage on this stock. The current market price is about 122 rupees and we have arrived at a target price of 187 rupees. Thank you. That's all from my side. And if there are any queries, please do drop in your emails at the at our email ID, and we will be and we will get back to you on the same. Thank you.